I want to thank everybody for joining us here today. I'd also like to thank Scott for taking his time to be with us here today. Scott is going to give us a brief background and education on how to turn non-performing assets into self-storage facilities with a higher ROI. Scott will go over the pros and cons of what's needed, how it should work, and how to maximize profits and minimize risk.
Thank you for having me. I appreciate the opportunity of speaking.
Great, thanks. I'm just going to briefly put my information up for any of those joining us today that don't have a self-directed IRA. You can contact me through our website or directly at rfischer, F-I-S-C-H-E-R, @camaplan.com. So I'm going to go ahead and turn this over to you, Scott.
Okay. Can you confirm that my screen is now showing?
It should be one sec. Yes, great. Awesome. So I know you have an impressive resume in the real estate industry. Can you tell us in the audience a little bit about your career path?
Absolutely. And first and foremost, thank you to everybody at Camaplan for putting this together. So always appreciate the educational component of being in the marketplace. So thank you very much for hosting this. I began in real estate when I began pursuing my Master's of Architecture in 1991 from the Illinois Institute of Technology. At that same time, while I was there, I was a TA for the owner of Optima. He was a professor at IIT, and he was working on a 50-acre. It began with a 1,000-unit development, but it got whittled down to 400 units. And so my master's work was working for him on this plan, 3 years in his office and then 3 years upon graduating there. So in 1992, I began working at his firm called Optima, and I worked on that project plus some others with him. But then in 1998, I founded CODA, and we are a design-build firm. And then in 2012, we started SSSK Capital Fund to take advantage of the recessionary commercial market. And in 2013 is when we began developing self-storage. So here's a photograph of my master's thesis. It was 316 condominiums, 64 townhomes, and 16 single-family homes. We had to give 5 acres to the local fire department, but it was formerly the Sara Lee factory where they made bread. And this is another project that I worked on. This was a 40-unit condominium. There was 3 of us who ran this project. I was the project manager. We had the project architect and then the project superintendent. But the 3 of us ran this $25 million, $40 million project. The first project I worked on was actually turned out to be $100 million in gross revenues. We also did conversions of apartments into condominiums. This is one of the projects that we worked on. And then in 1998, we bought a property for $300,000. We tore it down and built a new house and sold it for $1,050,000. We did that in 9 months, and this was the first project we did back in 1998. So since that time, we've done a wide range of speculative single families, as well as design build, condominiums, townhomes, mixed use. We're working on our 4th church right now, and we're actually converting a church back into a church. So that's a little bit about our path.
Great, that's impressive, Scott. So tell us about the fund that you're doing now, SSK Capital. What does it actually do?
Well, it's funny. I put this slide up here because it was sort of an aha moment where at one point in time you felt like you're walking off a little bit of an edge of a cliff. And when we first got into this, the market had gone into depression because of the big downturn, and we were looking at how to create opportunity within the marketplace and how to do it appropriately. And so we sort of felt we had to change what we were doing in order to, get a market advantage within the marketplace. And so we began looking at distressed self-storage, and we had someone came to us and said he wanted to buy a distressed self-storage facility. And when we were researching it, there wasn't really any distressed self-storage. This is in 2012, everything that we were seeing was very competitively priced. Everything had solid occupancy rates. In fact, the only quote-unquote distressed self-storage that we saw out there was, a small mom and pop that was maybe 20 or 25% vacant, and instead of selling it at a 7 cap, they were trying to sell it at an 8 or 9 cap. And so we didn't really see any market there where there was, quote, distressed self-storage to buy. So the challenge was to how to acquire and build a non-distressed asset at a distressed value. And that's what we were really trying to focus on, is how do we do that? How do we find a distressed asset in a non-distressed market? And so that was our aha moment, if you will, when we realized that we were onto something, was we could acquire a distressed asset in a non-distressed market at a distressed value and then convert it into a performing asset. And so that's how we really got into this, is we were buying a distressed asset and then converting it into a self-storage facility, and so we could competitively get in at 65% of the market price.
Very interesting. What makes you so passionate about this business?
Well, I mean, lockers are just, I get really excited to get up every morning and build lockers, right? I mean, that's the thing about self-storage. It's not the sexiest real estate investment out there. But why we really get into it is because within our strategy of acquiring them at 60% of marketplace, and being able to assemble the team to review the strategy and the feasibility, to rezone the property, negotiate it, convert the product, and flip the asset, what we are really being able to do is beating the establishment. We have found an inefficiency in the marketplace, and we're being able to maximize it. And my undergraduate was in history, so I enjoy watching the History Channel and learning about Edison and Rockefeller and all these guys. And what they really did is they really sought to find inefficiencies in the marketplace and how to maximize the returns within those inefficiencies. And that's what really gets me excited, is finding those niches, finding those areas that we can take advantage of those inefficiencies.
Great. So what makes this fund so special, and why do investors like doing this?
Well, it's really our track record. I mean, it's we can create some phenomenal valuation, so we can create both valuation in terms of changing the value of the asset pretty substantially, almost doubling the value of the asset, but we can also do it from a cash flow perspective. But ultimately, people like to come and see what we've done. So this was the first one that we did back in 2013. We took this empty warehouse and we converted it into, it began at 70,000, went up to 90,000 square feet of self-storage facility, and then Compass came in and they bought it out, and they're operating it now. We don't own it. This one was flipped, but this was an example of the first thing that we did.
Who are your competitors in this space?
Interestingly enough, our competitors are the people that are actually our buyers. So this is one of our other facilities that we did where you can actually drive in, and CubeSmart manages this one for us. But our competitors are really the big REITs. So Public, Extra Space, Uncle Bob's, Life, and Cube. Cube is the third largest operator in the country. And why they're our competitors is because they obviously have their own product. But that we fall in this category called third-party management, where we are the owner-operator. So it's no different than when you walk into a McDonald's or when you walk into maybe a Holiday Inn or Holiday Inn Express. You don't really know who owns it, but it's under that flag of that company. Well, they can develop their own properties, but mostly what they're doing is they're buying them from people like us that are developing them, and then when they're performing, then they become our buyer. So it's an interesting dynamic that our competitor actually becomes our buyer.
Great. What separates you from your competitors?
Well, there are many hurdles to getting into this business and being able to operate it and get it up and running. So there aren't any explicit barriers, but there are the challenges of entering into the marketplace, and that's one of the things that separates us. So our 7 unique selling points are: 1, we have the development background. We know how to get properties entitled, rezoned, so that we can do what we want to do with them. In each of the properties that we've done. So we're on our 5th one right now. 4 of them we've had to rezone. So we know how to dig through that process. We can implement the design. We know how to raise the equity. We can put together the debt structure. We can facilitate the construction. We have now the relationships with the management companies. And then once we do all that, we can refinance out our investors' equity and increase their rate of return until we sell it. So our strategy is, rather than just being a developer or just doing the design or just doing the build, we can control the whole process, and that's what makes us unique.
Nice. So what is it that you think makes your fund so successful?
Well, it begins with the research and our team. You know, we've assembled a great team of guys that are working with us. So Martin is our director of sales and acquisition. He's a licensed broker here in Illinois, and he's been averaging over $5 million. Just this year, today we're going to be closing our 2nd facility. This year, we bought one earlier in the year in June in Chicago, and now we're buying one up in Milwaukee. And so he does a great job of helping us locate and acquire the properties. James Lehman is our director of construction. He's a former Marine, but I guess once you're a Marine, you're always a Marine, so he's a Marine sergeant. And then we have Craig up in Wisconsin helping us out. So 1, we have a team, but then 2, more importantly, we have a process. Our process of how we can convert these empty warehouses, these empty buildings into self-storage. And so the combination of having the team, but also the systems, our systems are very important in terms of how we look at, how we evaluate it, and putting together the whole presentation. So this is an example of one of our end products where we had this empty warehouse and we just came and filled it up with lockers. And then once we're done filling it up, then we turn it over to CubeSmart and they run it. And they're the 3rd largest operator in the country. They manage about $7 billion of assets, and they're on the New York Stock Exchange. So we have a good group of people that want to work with us and help us facilitate these transactions. And that's what's important to us, is how we've established that whole group.
So risk is important to me and probably our audience as well. How do you guys mitigate the risk?
Great question. And that's primarily the reason why we really got into this, is that when we were looking at spec apartments or spec condos or spec homes or fix and flips and just the different opportunities out there. I mean, we've built over 200 homes. We've done lots of condominiums. We've done lots of different products. Is that a lot of it was subjective to the marketplace. But when we've really studied the self-storage, it is more of a retail business. And that's the biggest component about this, is even within the declining retail market, because of the Amazons and all those sorts of groups, or the Walmarts, the self-storage retail business is a thriving business. It's a $22 billion industry, and there's over 50,000 self-storage facilities in the U.S. So what it means is we really have to study the market, and that's what we put our primary focus on. We look at the overall economics, what's going on in each area that we're focusing on, and then on a broader segment. So when we look at a specific site, we are getting very specific demographic reports for half a mile, 1 mile, and 3 mile radius. And we will base our decisions strictly on the demographics. We can whittle it down to that very specific and knowing whether or not our product is good. Ryan, when I met your father, we were out in Oakland, and we were attending a conference, and a woman was presenting about her company and what she does, and she was doing these large luxury single-family speculative homes in Austin, and she said, well, I also have this property where I want to build a 100,000 square foot self-storage facility right, on the border of Austin. And so she just sort of threw it out there, and then afterwards I went up to her and I said, that sounds exciting. What do your demographics look like? And she said, well, I haven't done any demographics. I figured that's what the feasibility report would tell me. And I said, well, no, it really begins with the demographics, and then the feasibility report either confirms or denies what you're trying to do, but you begin by knowing it first, and then you tell them what it is that you're trying to do. And I said, why don't you give me the address and I'll get the demographics for you. And I plugged in the address, and like 18 facilities came up within 3 mile radius. And immediately I knew that this was not a good sign. I didn't have all the demographics, but when there's that heavy of a concentration around an address within 3 miles, that means it's a very saturated marketplace. And so we, even before we get to the feasibility report, even before we put an offer on the contract on the property, we will have a good understanding of what is the demographics for that specific site. And what we're looking for is population density, average income, medium income. We're looking at growth. We're looking at number of renters. We're looking at, most importantly, the square foot per capita of lockers. And the market average is around 7 square feet per capita. So if we know that, we're close to 7, 6 or 7 or above 7, 7 or 8, then we know that the market's saturated and it's a market that we avoid. So we don't even begin looking in that area. So when we got the full demographics back for this site that this woman has in Austin, she was at 7.9 square feet of lockers per capita, and there were 3 other facilities coming online. And I told her, I said, if you go forward with it, you're going to have a very hard time doing this just because of how much competition there is already in the marketplace. So I would recommend that you don't build self-storage on that location. And so when we're going through these things, this is an example of the feasibility report that we have done. It's a 175-page report. So we do our own demographics. CubeSmart runs the underwriting for us. We look at the feasibility report. We have the appraisals. We have all these different steps that we do to make sure that when we're going into an area, when we're going into a market, we have good supporting documentation behind us. It's just not like, well, we think self-storage would work here. We really have the data to back it up. So these are all the different things that they look for, and this is actually, a feasibility report, an excerpt from one of our projects right now, and you can see that there's, that we're looking at the market demand, and this is the number right here, 1.6. So there's 1.6 square feet of lockers per capita, and the national average is 7. So what this tells us is that there's plenty of demand, but very little supply. And so we know that we can go in very confidently, and then we also look at what the local rental rates are, and within those two things we can map this out very accurately in terms of the lease-up period and what the projected incomes are.
Awesome. So what do you think the risk is to an investor in your company?
Well, I think there's 3 risks. Can we build it on budget? And the second risk is, will the 3rd largest operator in the U.S. manage the building properly? And then the third one is, what happens competition coming into the marketplace? So, we've been building since 1998. I've been in the industry since 91. We're on our 5th project. There's if I compare self-storage to multifamily to mixed use to everything else, it's basically the most simplistic construction that we can do. Does it cost a lot? Sure, relatively speaking it does, but in terms of what we have to do these buildings, it's very much more predictable than if we're trying to come in and redevelop it from scratch. So there's a lot less risk on the budget. We can build 1,000 lockers. Our total project costs are typically around $6 to $7 million. If we're going to have 1,000 apartments, you would be looking at like $100 million. So the fact that we can do this on a much smaller scale, comparatively within the marketplace, to get 1,000 rental units gives us a very much a competitive edge. And then we're dealing with a publicly traded company that's on the New York Stock Exchange. They are, like I said, the 3rd largest operator. They know what they're doing. They understand the marketplaces. They understand what they're trying to do. But more important for us, they're really trying to grow through the Midwest, and that's where we're focusing our attention on. We've begun looking in Ohio. We have properties in Illinois, where we have one now closing today in Milwaukee. And then we're also looking throughout the Midwest. We made offers in Missouri and Indiana and so on and so forth. But the barriers to entry make it hard to really get the product saturated, and because of the zoning, because of the available land, because of available buildings. And so when we begin to see the product competition rising, that's a good indicator for us to sell. And then the REITs will typically buy from us because they want performing assets. And so we can control our risks by when we decide to leave the space and turn it over to the REITs, whether it be at CubeSmart or Extra Space or Uncle Bob's, whoever it may be.
Great. So can anyone invest in your company, and is there an opportunity to invest and make money?
Well, the first part of your question is who can invest? Well, we have a subscription agreement, and in that there's like 14 or 15 different criteria for accredited investors. We don't specify that. We let you guys pick how you best fulfill the definition of an accredited investor. If you meet those requirements, great. We send out an operating agreement. We have an offering memorandum for our work. We have our company profile and obviously the financial pro forma. So those are the things that we do to put out there to make sure that you guys fully understand what it is we're doing and how we go about the process. And there are a couple opportunities. This is the property that we're closing on today. This is what we're calling Platform 2, Wisconsin. We're on our second platform. The first one consisted of 3 properties, which we've done, and now we're on to our second platform, and we have 2 out of the 3 filled within that one. This opportunity is just west of downtown Milwaukee. So this is I-94 right through here. 94 goes from Detroit all the way out to the West Coast. And this is Miller Park, where the Brewers play. We got Potawatomi Casino right over here, and then here's our site right here. In this location, we have over 500,000 people within a 5-mile radius, and 50% of them are renters, and the median income is around $45,000. And so as a result of this, we have very strong demographics. This is where our market saturation is 1.6 square feet per locker. And this is the Miller Brewery right here, but most of the self-storage is either south of 94 or east, closer to downtown Milwaukee. So we're very excited about this opportunity. It's 100,000 square feet. We plan on putting 1,000 lockers into this facility. The other one, we're in the final stages of getting our SBA financing on this one. We closed it so that we could take the time to get the SBA financing of it. And this is in Chicago. It's 70,000 square feet. It's formerly the Lincoln Log Factory. And we're going to be converting this into about 640 lockers. As you can see here, you can see all the population density and how strong this is. This is formerly right here the 606 train line, which is now a major commuter path throughout the city of Chicago. And this is the building right here. We have over 550,000 people within a 3-mile radius. 66% of them are renters, and the median income is around $35,000, $39,000 per square foot, which means that we're going to make these lockers smaller than we typically do. The typical average is 90 square feet. We're going to condense these down to about 75 square feet per locker on average. And the reason why we do this is the lower the median income, the greater price per square foot we can command. And so in that sense, we can get more rental income out of it by having more but smaller lockers. Our property that I showed you earlier in Libertyville, which is in a very affluent community next to Lake Forest, which is one of the most affluent communities in Illinois, our largest lockers are the ones that sold out. So we actually started with like 640 lockers. We're now down to 580 because we're converting the smaller ones, the 10 by 10s, into 10 by 20s, and then they sell faster than if they buying 2 10 by 10s. It's just we can respond to the marketplace, and that's what makes it also very unique compared to apartments or condos.
Great. Do you think this is a good investment for a self-directed plan?
Well, I do for a couple different reasons. One, our ability to enter the product below the marketplace. We can take advantage of that. Our costs are going to be about 65% of value. There's market demand for the product. Our ability to refinance out the cash and keep our members in the deal. And that's our primary goal, is to return the equity as soon as possible, put a reasonable amount of debt on the product, and then continue to cash flow it until we can get the best opportune price to sell these things and then cash everybody out. And then between the tax shelters and the IRA plans, about 60% of our investors are IRA plans. And so that's just not my opinion that it's a good investment. That's our clients who are saying we think it's a good investment for their IRAs because they're investing their IRA money with us. So ultimately, we're able to own a far greater number of assets while controlling the amount of equity we have in them, and that's what we're trying to do. So, in our second project, 90% of our investors rolled their money into the third project, and that's now they own 2 properties for the price of their original investment. And so, not everybody chose to do that. We don't expect everybody to do that, but that is one of the things that we can do, and it's a great way to keep your long-term investments growing.
Awesome. So can you give us your contact information so people can contact you directly?
Sure. There's one. If I can go back to one other quick point here, if we can compare like $100,000 investment between like a turnkey rental versus a self-storage facility, just to run through some quick numbers here, if you were to buy a house for $100,000, you might make $800 a month in terms of renting it. So after expenses, you might be making close to $500 a month. So approximately $5,760 of annual income. So if we look at that as a cap rate, that would be a 5.76 cap, which is pretty aggressive within the apartment market. Now, if you were to put debt on that, your monthly income could go down to $200 a month, so you might make around $2,400 annually. A lot of people, within the bigger pockets market or in people that have been talking to us are really into the turnkey. But we look at turnkey as really just like a penny stock. It's like cash flow. So you're not going to see a huge rate of inflation. So maybe it's like 2 or 3% annually. So maybe after 5 years, your investment might be worth $110,000. So you get like a 10% rate of return. On our self-storage facilities, typically, you own a $100,000 investment will get you basically between 2 and 2, maybe 2.7% of the deal. So on a $500,000 of revenue after the splits between the the managers and the members, it is worth annually around $6,700. So that's 17% more rental income than the rentals. However, we've increased the valuation of the property tremendously more. We've increased it by 1.3, almost $1.4 million. So at 2% or 2.7%, you're looking at almost $20,000 in appreciation, which is 83% greater valuation than turnkey. So that's one of the reasons why we really believe that self-storage, there's the power in the numbers that we can take a non-performing asset, and because of the retail business and increasing the cash flow of the asset, we can increase the value of the property by almost doubling it. So our Milwaukee project, where our total costs are going to be around $7.5 million. The appraisals, the feasibility report, all the lending, all of it has been based upon a valuation of over $13 million. And so that's where we can almost double the value of these assets within a relatively short amount of time. Is that clear, or were there questions regarding that?
That makes sense.
Okay.
If you can put up your contact information so people know how to get a hold of you. But I did have someone ask a question in the chat box there. Do you have a minimum to invest with you?
We base our shares off of $100,000. We typically raise between $1.5 to $2 million for our each project. And so our accountant likes the fact that if we keep it at 100, it makes it easier. Rather than if we had 10,000, we'd have 100 investors, and it's a lot of K1s. So we are not a crowdfunding. We have done a half share on occasion, but majority of our investors are $100,000.
Gotcha. Makes sense. Well, we're out of time here today. I encourage anybody to contact Scott for more information. He can give you a lot more details than we have time here today. If you need help with opening a self-directed IRA or 401k, again, you can contact me at info@Camaplan or directly at rfischer, RFISCHER, @camaplan.com. I want to thank everybody for attending today, and especially you, Scott, for taking the time. I know you're busy with the closing.
Well, thank you very much. I appreciate your time, and thanks for the opportunity to talk with your group.
Absolutely. Everyone have a nice day.
Thank you.